Why you shouldn't invest in Tesla stock. Tesla Motors Inc. is widely regarded as a high-risk, high-reward stock, and it is one of the world's most intriguing public companies. Tesla's future has exciting potential, but it is difficult to predict. Tesla investors should temper their expectations and consider the risks that Tesla may face in the next 5 to 10 years. Let's list them out. Number 1. Tesla cars are still too expensive. Even with generous government incentives, such as tax breaks for alternative technology, potential Tesla Model S buyers face a high price tag that begins at $94,990 before any incentives or discounts as of November 2021. Even Tesla's new lower-cost Model 3 is $43,990 before tax breaks and gas savings as of May 2021, which is still out of reach for the majority of drivers. The cars are not only expensive for consumers to buy, but they are also expensive for Tesla to manufacture. According to Vertical Group analyst Gordon Johnson, the company lost approximately $14,000 on each Model 3 vehicle sold in 2018, though these figures may improve as the company scales up. Number 2. Tesla could run out of batteries. One of the first issues Tesla executives faced was the scarcity of batteries to power their products. Tesla's Gigafactory, which is still under construction in Sparks, Nevada, is expected to solve the company's battery crisis. The lithium-ion manufacturing plant, with a planned footprint of more than 1.9 million square feet, is expected to contribute to the annual production of more than 500,000 Teslas. Major projects, such as the Gigafactory, are frequently hampered by logistical or regulatory challenges, and it remains to be seen whether the factory will be completed on time. The Nevada government has approved the Gigafactory, which is expected to generate $100 billion in additional economic activity over the next several decades. Although the facility is only 30% completed, Musk has hinted that one Gigafactory may not be enough to meet demand, and the company may require several such facilities. It will take enormous capital expenditures to keep the company fully charged and shareholders happy. Tesla was the largest manufacturer of plug-in electric vehicles, with 14.55% of all worldwide sales in the first half of 2021. The next largest manufacturer was VW Group, with 12.52%. Number 3. Low gas prices. When gas prices fell in 2014 and 2015, Tesla's luster faded. After all, gasoline-powered vehicles compete with Tesla's offerings, and falling gas prices make gasoline-powered vehicles more economically appealing. Gas prices do not have to remain at decade lows to harm Tesla's stock prices. They simply need to be low enough to keep legacy vehicles on the road. Tesla's gas problem comes from two directions at once. The first issue is increased global oil production. The once dominant peak oil theory appears to have been debunked, with global oil production increasing each year from 2009 to 2019. Oil companies are becoming more efficient at finding oil and extracting it, thanks to hydraulic fracturing and horizontal drilling. Petroleum supplies are increasing, while internal combustion engines are becoming more fuel efficient. The average fuel efficiency of light-duty passenger cars in the United States continues to improve, according to the Bureau of Transportation Statistics. Tesla needs to sell a lot more cars if it wants to become a mainstream automaker and generate consistent cash flow. Consumers are less likely to switch to electric vehicles if petroleum-based fuels remain significantly cheaper. Number 4. Increased electric vehicle competition. Tesla isn't the first company to develop electric vehicles. Interestingly, Thomas Davenport invented the first electric automobiles in 1834. But Tesla appears to be the most successful so far. Due to high retail prices and limited driving range, two notable competitors, the Chevrolet Bolt and the Nissan Leaf, failed to gain early traction. As of October 2021, the Nissan Leaf starts at $27,400 before incentives and has a range of up to 226 miles. The 2022 Chevrolet Bolt, which starts at $31,000 before incentives and has a range of 259 miles, outperforms Tesla's standard Model 3's 220-mile range as of October 2021. Mercedes-Benz, Volkswagen, Subaru, Ford, and BMW are among the companies that plan to enter the electric vehicle market in the coming years. If this occurs, Tesla's market share may become overcrowded. Apple Inc. believes it can compete with Tesla in the transportation industry, and Google has also placed bets on the auto industry. Tesla is understandably concerned about the companies with larger existing consumer bases. Number 5. Tesla may never recoup massive expenditures. Musk once famously noted about his company, "We are going to spend staggering amounts of money on CapEx. Lots of investors like to see high capital expenditures, but there has to be a payoff on the other end." This seems particularly true in an infant industry paved with failed startups. Tesla has already spent billions of dollars developing the Model 3 and Model X vehicles, and the battery factory is not cheap. Tesla estimated in an SEC filing for the first quarter of 2021 that capital expenditures would likely increase to $4.5 billion or even $6 billion per year. According to SEC filings, Tesla may spend up to $6 billion per year on capital expenditures in the coming years.